Brokers Alliance and the National Insurance Clearinghouse present the Business Insurance Zone, a Bravo video event. Broadcasting in HD 1080p on Vimeo, YouTube, the Insurance Newsnet, Agent Navigator, BrokersAlliance.com, and on Facebook, LinkedIn, Twitter, and the Insurance Forum. And now your host, the whiz of the biz, Steve Savant. Well, welcome everyone to the Business Insurance Zone, the talk show that spotlights insurance in your practice, keeps you up to speed on insurance news and products, features insurance strategies from top advisors. Get in the zone, the Business Insurance Zone. Our email address is thebiz@brokersalliance.com, and you can call us at 1-800-290-7226, extension 147, for any quotes or questions you have on life insurance, disability, long-term care, annuities, or group pension plans. And remember, I'm not a tax advisor or legal CPA, so before moving forward with any of the strategies that Eric and I are going to talk about today, remember, always check in with your legal counsel, your CPA, and if you're the broker-dealer, always check in with your compliance officer. Well, today, of course, I have with me Eric Palmer, who is the National Director of our Advanced Markets. Eric, welcome to the show.
Glad to be here.
We're talking today, I thought this was pretty much a dead subject, but maybe not. We're talking today about premium financing. I think of that show with Arnold, what was it, Danny DeVito. It's called Other People's Money, right? Did you ever see that show?
Oh yeah.
And I think of like the whole issue of premium financing is not my money, use somebody else's money, the banks or whatever.
Right.
Now, I know that in the market, this was a hot market pre-2008.
Absolutely.
I mean, why should I spend my money if I'm a high net worth client? I have liquidity, right? I have serious market growth. A lot of this was in real estate,
right?
Unfortunately.
Quite a bit.
Now, that was the day. Are those days dead?
They're not dead, but they're very much different. Okay, so pre-2008, it was the Wild West of premium financing. I mean, we had no shortage of capital. There was a lot of money in the market, and it was, very easy for a client to secure money on a non-recourse basis. Mm-hmm. That means we didn't fully collateralize the loan. There was no personal guarantee. Mm-hmm. We just went off the financials of the client. If they had the wherewithal, there was a lot of opportunity to get that money put into these policies, and the client had very little exposure.
Mm-hmm. So when I think of the word non-recourse, that's almost going to be a pre-2008 word, because anything we're talking about now, I don't know that it's going to be recourse.
Everything now is full recourse, and there was a lot of evolution in this market. The life settlement market really trailed that pre-2008 premium financing, and there was a lot of value, a lot of opportunity, and again, the landscape has changed. Insurance companies today that we work with anyway do not accept non-recourse premium financing business. So everything that we deal with is full recourse. It means it's 100% collateralized in one way or another. Now banks today are a little bit smarter. They are definitely offering a little bit more in terms of restrictions. They're not guaranteeing loans for a very long time, and they're making sure that those policies are 100%, if not a little bit more, collateralized with cash on cash. So, where real estate was an availability for us a couple of years ago, with the markets where they are today, banks don't want to use that for collateral. So it's cash equivalents. We're talking about marketable securities, CDs, or the cash values of life insurance
Personal
policies.
guarantees by the client?
That's on top of the 100% collateralization.
Right. So I have personal guarantees. I have to be 100% in liquid assets, and hopefully the policy actually is doing something about it.
Well, that's one of the things that we really try to do is we look at using policies that close that gap as much as possible so that the client's collateral exposure is very small. There's four major categories that we look at when we're trying to balance the equation here for premium financing. And so when you're doing full recourse, there's some things that we really have to evaluate, and this is what helps us determine whether or not the client is a good or bad for this type of situation. I'll tell you this, there's not as many that qualify as there were before. Clients have to have very strong liquidity, very strong financials, and we have to have the ability to look at this from the perspective of, can they pay this premium without the premium financing? If they can't, then premium financing most likely isn't going to get approved.
Now, is there a minimum threshold that we're looking at now, net worth-wise, liquidity-wise?
There's a minimum net worth that we're looking at of about $5 million. There are some programs out there where you can do a little bit less than that, but really that's the border, because when I look at internal rate of return, exit strategy, and the like, $5 million or better of net worth is really something that comes into play there. I really encourage right around 10 or more to make the deal easy to do. So these four categories that we want to balance, I mentioned the first one there, it's collateral. We want to make sure that the client has as little exposure to collateral needs as possible in a range of time that meets at least their life expectancy. I want to make sure that this plan can't completely blow up on them, and they'll have to post more than they even have in terms of collateral.
Are we looking at LE, life expectancy, more and more on this issue then?
We evaluate life expectancy strictly on the fact that we want to calculate internal rate of return. We want to make sure that the death benefit and the other things that we're providing here in this policy meet at least that expectancy, and we try to pad it even a little bit further. Okay. Absolutely. So collateral is a big one. The other is out-of-pocket interest. We want to see the ability for clients to pay interest on these things.
So nobody's doing roll-ups now?
There are some roll-ups out there. They're tough to do. You got to have a client that has really strong liquidity. But we look at out-of-pocket interest exposure. In some situations, we've even been able to roll up partial amounts of the interest and levelize the exposure on a year-on-year basis so that we can compare that to, say, a low guaranteed UL or something else that they may want to purchase. So collateral and interest are big factors there. The third one is that net death benefit, and I really want to emphasize net death benefit. If you die, the loan's got to be paid back if you haven't paid it back already. And so that's coming out of the death benefit that's in these policies. So if I buy a $10 million policy and I die at age 80, my estate might only get $5 million of those dollars because it might have cost me $5 million to premium finance.
Is underwriters, are they taking into effect the net number then? So I have to gross it up to pay the loan off and then come back, or no?
Somewhat, but it's really, really tough. Financial fraud has been rampant in this industry and a lot of other segments of the financial industry here, especially in the last year. So
yeah, those banks contaminated us, I think.
You know what? We can blame a lot of things, but the insurance underwriters are really strict on financial underwriting. I mean, the client to qualify for $10 million so that we can net 5, they've got to qualify for $10 million of coverage. So it's hard for us to convince the insurance company that the net effect of the death benefit could be different. What they want to see is, can this client pay for this policy on their own? What happens after the premium financing, or what's the plan 5 years from now? Is there any exit strategy built into this thing? So the insurance underwriters are actually looking at this pretty closely, especially with the onset of the STOLI issues we experienced over the last 5 to 10 years.
When I think about the financial underwriting, and because we've always done financial underwriting for businesses, business loans, and this is a loan, but it's really not technically business most of the time.
Right.
So I'm trying to see, it's gotten tighter in financial underwriting, and we have to make sure the LE, the timeline works, and you're padding it.
Absolutely.
2, 3, 4 years on the other side. And on top of that, we're talking about collateralization of guarantees. Now that policy's got to have some serious early cash values.
Right.
I mean, and then we're talking about collateralizing seriously liquid, marketable securities that can be cashed in at the end of the day.
Right, exactly right.
Yeah.
The fourth and final thing that I really want to make sure we evaluate when we're doing these types of deals for clients is the internal rate of return and the exit strategy. We're using a lot of different types of policies to premium finance, but what we want to make sure we cover is there an opportunity to get out of this thing before death? While the client's still alive, what can change in the environment to make them want to get out or have to get out of this loan? And so we want to build an exit strategy into the plan, as well as look at what the internal rate of return is, and that again is where that life expectancy comes into play. If I figure someone's going to live to age 88, then I want to know by age 92 or 93, do we still have a strong internal rate of return versus paying a guaranteed universal life premium year after year?
I'm thinking of the IRR, the internal rate of return. I'm measuring that between my gross up number, right, because I got to pay the loan back,
right,
and then am I still making a decent IRR net of that expense?
Exactly.
So
that leads us right into the types of policies that we have to use. We are looking at a lot of index universal life in this space right now. We've done some premium finance with a little bit of whole life in the past. We've done premium finance with current assumption universal life. There's a lot of different type of product out there, but the index UL really provides us the most opportunity for that arbitrage that you're talking about. We want to see a 2.5% to 3% spread over the loan rate every year, because what that does is that puts us into a position to exit this thing in a 10 to 15 year window. That means that we're paying the loan back and we're earning enough on the contract to build up additional cash so that we're not only 100% collateralized, but we got money to start putting towards principal.
And I get that, but that's in a good market. Now, I'm looking back at the S&P 500, 2001, 2000, 2003. We had 3 loser years in a row.
Right.
So in these contracts, even though you're not going to lose anything, although I must say you are going to pay policy expenses, which would take a zero crediting
Right.
policy down a couple points. Yeah, good.
A company to mention here, because you mentioned the 0%, is AXA Equitable. Their Index Universal Life contract has a very, very strong cash value rider, so it bumps up nearly 90% or more cash value right off the bat.
Right off
so
the
your
bat,
exposure is very slim, and they offer a guarantee of 2%. So
Your floor.
Your floor is 2%
So
on that
almost
contract.
all your insurance costs, not all of it, but pretty
good
close.
portion of it is covered.
And is that a contractual guarantee? Or
It is a contractual guarantee,
Well, that's
absolutely.
huge and strong. Because when I'm looking at the index arbitrage, which I really appreciate, but I'm trying to think, well, what if I don't have any of this credited?
Right.
And I already experienced this in the 2001, 2, and 3 S&P. What does that look like?
Exactly right. That's why.
By the way, are they major players? And you mentioned AXA as an example. Are they a major player in this area?
Right now, AXA is getting probably 60 to 70% of the looks of the policies that we're writing today, and that's
Wow.
because their product is, in my opinion, and we've done some index UL analyses,
Exactly.
and we've done some other shows on this. It's one of the strongest policies for premium financing. It's a
Mm-hmm.
strong company. It's a strong name. That 2% is hard to
Oh,
look
yeah.
away from,
No,
and that
that's
cash
great.
value rider is really powerful.
Is that cash value right? Does that cost you any more to play that game?
It does. You know, they just changed that cash value rider. It's a good thing that you brought that up. It has a 48 cent per thousand charge carried for 8 years. So if you're looking at a $10 million policy, you have $4,800 a year, you got to carry on a charge for that rider. But all policies that have these cash riders carry those types of charges. The fee structures are a little bit different, but everybody's got to charge to this. This type of stuff isn't free. The insurance company is pushing a lot of cash up front into that contract. It's also costing you a little bit of your commission. It's a honeymoon commission over time. But again, when we look at the size of these deals, that's not even a part of the discussion.
Yeah, I mean, we're trying to do the best thing for the client. We
Right.
need liquidity. We need to be able to play in this game.
And we want to mitigate that collateral.
And I don't think we intended to push AXA here, but I guess with their player, they're
They're
a
a
player.
strong company.
Well, listen, when we come back, we're going to talk about the term dilemma in this whole premium financing. I mean, some people are just waking up to the fact that we can do term. If you want to talk to Eric at all, just call him 1-800-290-7226. His personal extension is 103, or you can write him at eric@brokersalliance.com. You're listening to the Business Insurance Zone. I'm Steve Savant. When we come back from the break, we're going to cover this whole thing of premium financing and term right after this commercial break from our sponsor. Steve Savant here. For years, I've heard that less than 2% of all term life insurance ends in a claim. That's not many, and clients had to die to receive the benefits. That's the old term insurance. Now start selling the new term insurance. The term insurance that covers your client through a chronic illness, a catastrophic event, or a terminal diagnosis, and pays their monthly premium during extended periods of unemployment. What term life insurance can do all that? Western Reserve Alliance Advantage Term with living benefits. No other term insurance product bundles so many solutions to life's unexpected problems. And all in one policy. So for more information, call Brokers Alliance 1-800-290-7226. Stop selling the old term. Start selling the new. Well, welcome back to the Business Insurance Zone, the talk show that focuses on insurance in your practice. I'm Steve Savant, your host, financial color commentator, and interviewer extraordinaire. And of course, with me today is Eric Palmer, our director, our national director of Advanced Markets. And we're talking, and remember, you can watch any of these shows. We're just not just today. You can watch it on Vimeo, YouTube, Insurance Newsnet, Agent Navigator, where we blog at the Insurance Forum, on our YouTube, and our Facebook account, our Twitter account, our LinkedIn account. We're everywhere you want to be, I got to say. And remember, our email address, if you want to write us for any of our quotes on anything that we sell, of course, thebiz@brokersalliance.com. You can call us 1-800-290-7226, extension 147. On any of those quotes or support material you need on life, DI, LTC, annuities, or group pension. And remember, I'm not a tax or legal advisor, so before moving forward with any of the planning ideas we come up with, please talk to your CPA or your attorney. And if you're with a broker-dealer, always check in with your compliance officer. Well, we're talking about premium financing in the first segment, and we're continuing that now, but we're talking about it in, I remember when I first heard this a couple years ago when we started doing term back in the day, I thought this was bizarre.
Right.
But talk about, how do I use term insurance for premium financing?
Well, this is actually, it's evaluating how to get around term insurance with premium financing, and it's something that you've really got two scenarios that you come across. We see a lot of buy-sells, key man types of insurance purchases made, very large face amounts, $10+ million. And most often the company is evaluating term because it's the lowest cost option to cover that executive for whatever period of time that they're working for the company. What we find, though, sometimes with term insurance is that we may purchase a 10 or 20-year policy. The executive reached our 21st year, and the conversion option isn't as good as it maybe would have been 10 years prior when we purchased the policy. And it's very expensive at that point as well. The company doesn't necessarily want to come up with 3 to 4 times more premium per year to cover that executive. The other side of it is we have an existing term insurance policy. I'm already paying premiums at X amount of dollars per year, and I want to get a permanent policy. The tail end of my policy is coming up, and the conversion, again, is really expensive. So what we're looking at is using premium finance strategies to be able to make that continuation of premium or continuation of coverage, or to purchase those executive type policies or key mans or deferral and match, and keep that cost as low as possible for either the company or the individual. So there's a special program that we've put together, and there's a few little pieces of information to kind of hand out here. What we're looking at is term coverage of $5 million or more. We're looking at an age range of 20 to 63. That's where it really kind of works here.
Wait. Down to 20?
Down to 20, absolutely.
That sounds way too young.
It seems young, but we find that there's a lot of young executives out there, and there's a lot of opportunities for $10+ million of coverage, and they're looking at, do I buy term insurance, do I buy permanent insurance? And at 20, it's even more important to potentially lock up a permanent policy, because it's going to provide a lot more opportunity. You've got that solidified coverage for your lifetime, and where the term could possibly run out and cost you more later, this one's more levelized.
But isn't this a real arbitrage between the term rate and what interest I'm going to be paying?
That's exactly right.
Bottom line.
That's what it comes down to. So what we're trying to do is we're trying to look at an opportunity for the client to have less exposure by paying interest than they would by paying premiums to the term policy. So give a good example here. We had a client looking to purchase a 20-year term. Death benefit was $10 million, and the lowest cost premium was $33,975. So over $33,000 a year for this 20-year term policy.
But by the way, just a little side note, we track the entire term market on a completely competitive grid. And so when we did this, we priced this out. If you ever want that grid, just call Eric. You can call him direct again, 1-800-290-7226, extension 103, or write him at eric@brokersalliance.com. All of our recruiters, we all have these grids comparison. Anytime you want to know who's the term player, in this case, we need to know that so we can see if they can play in the premium finance.
Absolutely. So what we did is we looked at this client's potential exposure to $33,000 of premium a year for 20 years, and we evaluated whether or not we could purchase a permanent policy, cash value rich, so that the collateral exposure was mitigated, and keep that out-of-pocket interest reduced or under that $33,000. And we also look at using index policies, because again, there's going to be a crossover point. If we can average a certain rate of return in a 10 to 15-year window, we potentially are in a position to use the policy to start paying some of these interest costs, or to at least reduce them. So there's a lot of opportunity with this type of a strategy. Now, there's a lot of risk, like we discussed in the first half, but this is a strategy that, for this particular example I gave, we were able to come in and provide this client with an option of $25,000 of levelized interest for 10 years, and then we were able to show that the policy, potentially based on the rate of return we illustrated, could cover the rest of the costs on an ongoing basis. Or by rolling up partial amounts of that interest, we could levelize the $25,000 at least for that 20-year window and save the client quite a bit of premium over that period of time.
So the banks are okay with this strategy?
They are. Now they're going to look at the liquidity, the wherewithal, the financials of this client. They want to make sure that, let's say the policy doesn't return, we're at a bottom type of a market, the interest rates are going up, all the kind of the worst case scenarios come together at the same time. They want to know, does this client have the money to continue this policy and to pay back this loan if that happens? And if the answer is yes, then we can get these deals done.
We're in this market in term because we all thought going in that the liability to either the business or the estate was going to be limited to a 15, 20-year period.
Right.
And as I've gotten older in this business, been in here 30 years, I have to tell you, everything we thought was going to happen the coverage, liability, and exposure went well past whatever we predicted back 10, 15 years ago.
Oh,
so,
yeah,
we're
absolutely.
sitting on 15, 20-year term. We probably should have sold permanent all day long.
Oh, absolutely.
And everybody kept telling us, we're trying to buy the cheapest way. Now we said, well, maybe we can do that with a permanent policy and use the interest on the premium financing loan. And you're telling me that number is below the term market of 33 grand on this example.
Exactly, and that's why I emphasize that age range at the beginning, 20 to 63. When we get past age 63, these permanent policies do become a little bit more expensive. We have a high cost of insurance. The underwriting is not as good. We're into more of a standard or substandard type range.
Or if you're talking about Steve Savant, I'm preferred non-smoker, and I'm in that range.
Absolutely, but it does get harder to make that cost lower. Now we'll certainly look at everybody over 63. We'll see if there's some opportunity there, especially in that conversion type of scenario. But again, those age ranges are important if you want to really market this type of a concept.
If I want to do a quote on this, how do I go about it? I know I call you at your toll-free number, extension 103, or write you at eric@brokersalliance.com. But I want to know, what do I do? How do I know if this is going to work? You will do the math, right?
Right. We'll do the math, but we have this a really great checklist. It's something that you can sit down with your client when you're doing some just brief analysis. When you're talking about term insurance or conversions and that subject's on the table, this is something to break out of the briefcase, go down the list, see if this is something that makes sense for your client. And then just email, fax it, get it to us in any way you can, and we'll sit down, we'll give you a call, we'll analyze the situation. I will mention this. It's not 100% of the time. It's more like 40-50% of the time that these scenarios really make sense for the client.
So
but
about
I think
half.
What's really important is that we're going to do that analysis for our advisors, and we're not going to put the advisor in a position to make a bad call for the client. So if this doesn't work, we're going to tell you, and we're going to provide some other alternatives that might potentially get the deal done.
I'm thinking we are a major player in the United States on term sales, period. Right. So I'm looking at Brokers Alliance in-force ledgers. I mean, our in-force business on term alone is huge. So when I'm looking at when I start crossing over, what death benefit am I looking at? About $5 million or so?
I would say if we have advisors currently listening to the show that have worked with us or without us in the past, and you've got clients with $5 million or higher policies in the death benefit range, again, they're in that 20 to 63 age range. Give us a call. Let's take a look, because there could be some more opportunity there for you to create some permanent coverage for your client and keep that cost right around where it is with the term insurance.
Now, we just did a big data search in our own block of business.
Hundreds and hundreds of policies.
And we started letting people know.
Absolutely.
Our agents, our producers were by the way, this is one thing where we're very proactive on database mining. Many IMOs have yet to come into the technology that's available, and we mine it, and we went out to our own block to see if we could test market this, and we had huge response on this.
Absolutely, and it's important to note that we're calling the advisor that sold the policy to share with them the opportunity they have. There's a lot of companies out there, and there's a lot of worry that are you mining my clients for other reasons, and who are you giving it to? And I want to really assure our advisors that, listen, when we come up with these strategies and we go use our technology to find out what you've done in the past, we're calling you directly back and saying, hey, look, we found some opportunity for you, and we think you can really help your clients advance their coverage.
The great thing about that, Eric, is that about over 90% of our producers are not aware of the window of opportunity here.
Absolutely.
And because remember, we talked about time of conversion, what does the policy allow? We have to kind of micromanage that. We kind of know that going in before we make the call to the producer.
Absolutely.
So what we've done is we've tried to do all the R&D work way ahead of schedule, so that by the time we're talking to you, we think we got a legitimate play here.
Right. Absolutely right.
So talk a little bit at the end. I'm still amazed that we're doing this on a term chassis. I mean, even back in the day when we first started doing this, we have term insurance now that's going pretty doggone long. I mean, 25, 30 year, even I think it's Western Reserve's out at 40-year level term. I mean, it boggles the mind.
Right. I think the opportunity really lies in liquidity. Whether you're a developer or an engineer, after 2008, people are extremely conscious of those ongoing expenses, and we find that the first thing that somebody feels like they want to let go are those ancillary insurance coverages, and it's the worst decision that they can make. If your estate has an exposure of $5 million or greater, the last thing you should do is drop that coverage, because when you die, your family's going to be stuck with it, or your business is going to be stuck with it. but they're very conscious of those costs. And if you're paying over $25,000 to $30,000 a year for term insurance premium, it's something that you're constantly trying to justify. So what we're showing our clients is opportunity to keep those costs as low as possible so that we can put a little bit more cash hopefully back in their pocket, respect the fact that liquidity is a big issue for businesses and individuals right now. And I think that's what makes this a market, what makes the opportunity.
Even with the reconfiguration of the estate planning, taxation, $5 million, so forth, the federal made their change, but all the states didn't.
Right.
And so many states are not shadowing the federal estate tax, and most of them are way lower. In fact, I want to say, and I'm thinking of a state in the Midwest. I can't remember if it's one state, but it was like their bottom number was $365,000
Right.
there before you started getting taxed on your estate. So even though estate planning has jumped for $5 million individual, $10 million to married couples, many of the states did not travel with the Fed to go up to the 5 million mark. So this could even be a bigger play.
Absolutely. It's quicksand that most people don't realize is out there. And we've done the analysis. We actually have some research on what states have what minimums for those estate tax holes. And we want to make sure that your clients actually have the right amount of coverage, not just for federal, but for state. So give us a call. We'll share this information with our advisors. We want to make sure that you have all the opportunity in the world to discuss with your clients the real risk that they're even on the state level.
Yeah, and if you have attorneys and other fiduciaries who are saying, hey, we're going to wait a couple of years on this estate plan, remember, substandard clients' health never waits for that, okay?
Right, exactly.
But more than that, it's the state issue of income tax or estate tax I'm really concerned about. And again, Eric said, I love this. We've collected the 50-state grid to tell you what the numbers are, who's playing, who's not playing. I mean, that's the kind of information we always want to keep up ahead. We're trying to always give you the best and top-of-the-line intel on everything that we're into. Well, Eric, I thank you about this. I mean, I'm still blowing my mind. We're talking about term insurance with premium financing, and I know we've been doing it a long time, but I'm still kind of caught by it. Remember, you can contact me on my email address at thebiz@brokersalliance.com or call me at 1-800-290-7226, extension 147 for any of our quotes on all the products that we sell. And don't forget to hop out on our website at www.brokersalliance.com. I'm Steve Savant, and you're listening to the Business Insurance Zone. That's the buzz on the biz today. It's all about premium financing. Get into the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse and Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. You can contact Brokers Alliance at brokersalliance.com or 1-800-290-7226, extension 147.